The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, ladies and gentlemen. Welcome to the NUPGE Pension Basic Webinar Series. My name is Elizabeth Ballerman. I am the Secretary of NUPGE. Pleased to host this series for you. And just a couple of housekeeping matters. We've scheduled this webinar to go about 45 minutes. You have an opportunity in the chat function to ask questions of the panelists as they come up to you, and we will have time at the end to ask them. So please don't hesitate to frame your questions during the webinar, and they will get to us. Then we are recording these webinars, and we'll have the video available to share with the attendees afterwards. So just a little bit about the background. NUPGE has started this webinar series for pension activists, advisory committee members, union officers, trustees, and members within our components, because you play a crucial role in securing and defending our decent pensions for our members. To protect those good quality pensions and encourage the investment of pension plan assets in the best interest of the plan members, beneficiaries, and the communities, we are hosting these seminars to provide you with the information and hopefully also to add new pension activists to our group. We've developed this webinar series in conjunction with the Shareholders Association for Research and Education. We want to thank Peter Chapman, Tamara Herman, and Hugues Letourneau, who is doing our technical assistance today, for both developing and helping us with this. So about today's webinar, we are looking at pension designs because there are constant changing challenges and there are constant needs to adjust plan design for the retirement security of our plan members and beneficiaries. Across the country, there are no two plans within NUPGE that are the same, and of course we have varying plans within the provinces themselves. So we are going to compare and contrast the differences between NUPGE component major plans. We haven't got enough time to go through all of them, obviously, and our speakers will present updates, analysis, and perspective on consideration of these pension plans. And the pressing challenges, of course, with attacks on our pension plans and pushes to declining pension coverage. We're pleased to have with us two speakers, Phil Rivard, who is the VP of Pension Policy and Funding of Alberta's Local Authorities Pension Plan, Pension Plan Corporation. He is going to go second, provide an overview of our plans, and full disclosure, the LAPP is the plan that I am a deferred member of. And Derek Dobson is the CEO and plan manager of the CAAT pension plan, and he's going to talk about about pension plan design questions. So Derek has been a tireless advocate for shared risk multi-employer defined pension plans for a long while. And in the past few years, his plan has been in discussion with employers from the public and private sectors interested in joining CAAT. Notably, new employers are the Youth Services Bureau of Ottawa and the Royal Ontario Museum. Both have merged their single employer defined benefit plans with the CAAT plan. Derek has an undergraduate degree in mathematics from the University of Waterloo, is an associate of the Society of Actuaries. He is co-chair of the Canadian Public Pension Leadership Council, forgive me for that, and a member of the ACPM, the Association of Canadian Pension Management Board of Directors. And over to you, Derek.
There we go. Thank you very much, Elizabeth, for that introduction. I'm very much looking forward to the questions from the people who are participating live. I think that's where we get the most benefit out of the webinars. I'll start off with some general comments that plan design is for sure not an exact science. And as things change, whether that's in the workplace or longevity or other elements, that we also have to consider making from time to time plan design changes where they're necessary. I will also say that in my pension career, I've not seen any design that is perfect for everyone who participates in the plan or is perfect for the long term. So there is definitely a need to consider the needs of the members, the majority of the members, for most of the circumstances that will arrive. And from my perspective, what we're really trying to accomplish from a good plan design is to make sure that all members who are participating see value in participating in the pension plan. It's a tall order, but something that is achievable. And when design changes are becoming necessary, I would strongly encourage that everybody has to have a good process to consider when changes are needed and make sure that all stakeholder needs are considered. So I was asked to talk about some high-level issues related to plan design, and they're included on this bar. Plan design on the surface seems like a fairly straightforward perspective, but as suggested by this visual, there's a lot that goes on beneath the surface of a good plan design. What's emerging today is definitely a bigger focus on making sure that contribution rates are stable and affordable and are appropriate for the benefits being earned. And more with jointly risk-shared plans, that includes both member needs and employer needs overall. Secondly, we've seen the emergence of more part-time workers, and they have a strong need for a good retirement plan as well when they go to retire. And various rules across the country have various waiting periods and other times. So for example, the CAAT pension plan, our board and sponsors committee made the decision a few years ago to allow part-timers and all contract staff to join immediately upon hire. So even just access to the pension plan is a core plan design issue. There's been a lot of talk over the last 5 or 6 years about longevity, and should it have an influence on how plans are designed on a go-forward basis. For sure, the longer that people live, if they retire at the same age, that does have a cost impact on the plan, but from my perspective, it's not a sustainability issue, it's just a cost issue that needs to be addressed. Longevity also brings in the plan design feature of inflation protection, because if the average member is going to live 20 to 30 years in retirement, inflation can have a significant impact on their purchasing power over their retirement career. And finally, on longevity, there's been a lot of calls recently on changing how our plans are structured for early retirement benefits. Some would suggest that early retirement features are not appropriate in today's environment of increasing longevity. For example, some would suggest that for every 2 years we live longer, early retirement should start 2 years later. Personally, I'm not a proponent of this type of view. I think early retirement features are specific to the workplaces that the plan is involved in. Some workplaces, for example, healthcare, nurses, for example, cannot work beyond certain ages where it becomes very physically difficult. So early retirement features are still a necessary component of most pension plans from my perspective. And we need to understand more about the impacts of early retirement in terms of different types of careers and give the flexibility to each sponsor of each plan to design that planned early retirement features that are appropriate for their group. So this is not a one-size-fits-all type solution. However, some economists would suggest it is. The next element is wage patterns. As we've seen, especially in the broader public sector in certain elements, we've had significant wage suppression or frozen wages for a long period of time. So a lot of plan design people are considering, well, how impactful are final average earnings plans? And some have been career average pay plans for a long time. Some are final average earnings 5 plans, and I think we'll hear more from Phil on that later. But understanding the wage patterns of your workforce and workers are very important to making sure you get the plan designed right. The second last element on this slide is CPP integration. As I've been giving presentations across the country, a lot of people are saying, should we change our plan design for CPP? I have a slide later to get into that in a little bit more detail. And finally, one of the emerging issues related to plan design is risk sharing. What's the appropriate amount of risk sharing between employers and members, whether that be with contributions or conditional benefits? Speaking on conditional benefits, the CAAT pension plan is one example, uses conditional indexing to help balance the cost and the funding and the benefits of the plan. For certain, members would prefer to hear the word guaranteed inflation protection. But when you use the word guaranteed inflation protection, it does mean that that needs to be fully reflected in your valuation and can result in contributions that are too high for members and employers to afford. So in 2007, for example, the CAAT pension plan sponsors decided to make our inflation protection conditional on the funding position of the plan. For CAAT members specifically, this means that it's still a very high probability of being paid because our funded ratio is at 113%, and paying conditional inflation protection is required as long as we have $1 of surplus. So it's the first priority of the plan once we're fully funded. And we have been able to pay conditional inflation protection, for example, including during the global financial crisis. So we've never missed a payment. So that's the big balancing item from my perspective, is the funding or the contribution side versus members' desire to have guaranteed inflation protection. In our plan, we've made conditional inflation protection automatic, so that if we are fully funded, it has to be paid. For some plans have gone down the route where it's more ad hoc, and that it's a decision of the trustees or sponsors each year or each valuation when it's filed to grant it or not. So from a design perspective, I think those are the key issues in relation to conditional inflation protection. Is it guaranteed to be paid or not based on funding levels, or do plan trustees need to make plan amendments each and every time? This is a little bit more busy slide on CPP integration. But I thought I'd share my perspective and the facts that have led me to my perspectives. First of all, we're all aware that CPP benefits are increasing. It will take 30 or 40 years for those planned CPP enhanced benefits to fully mature. So it's something that's going to take a long time for members to see the full benefit of those changes. At the same time, it's a fact that as CPP contributions are going up, being phased in a couple of years, that the total retirement contributions from workplace pensions, from CPP, et cetera, are definitely increasing, because workplace pension plan contributions are also increasing. But I'd also note, from at least in the sectors that I'm familiar with, typically members are joining later. So they're joining at a higher entry age, which fundamentally means that when they go to retire, they'll have a shorter service period. In addition, part-time employment is on the rise, especially for people earlier in their career, which means they might not have access to workplace pension until a higher age. And finally, the last fact that I've listed on this slide is that, from my perspective, as we age as a society, healthcare costs are likely to go up significantly. This will likely mean more costs being placed on individual members, as we see some employers closing down healthcare benefit plans post-retirement, which means that we should perhaps be focusing on trying to target a higher income in retirement, since there's going to be more expenses in retirement as well. So from my perspective, the key questions is the plan's focus on an adequate pension in retirement to meet the costs that members are going to foresee? So for example, the benefit replacement focus, or is it the amount of contributions that current active members can afford to go into retirement savings? This is a very difficult question. And as the facts listed before, I don't think it's right or appropriate, at least for the plans that I've been involved in, to assume that the norm, when our originally pension plan designs were created, that we're going to see 35-year full-time careers in one employer. So we have to understand, what is our goal? Is our goal to help members retire with adequate income? Then perhaps we shouldn't be integrating our plan designs with the increased CPP, because if they have shorter service, they're going to have a smaller workplace pension overall. CPP is going to be a little bit higher, but net, perhaps they're just arriving at the right retirement income at the end of the day. So this is an important design consideration, rather than just looking at the typical 35 years times 2% is the 75% replacement income. It's good to look at the actual data of how much service members have when they retire. So for example, in the CAAT pension plan, our average retiree retires with about 23 or 24 years of service, which is much lower than it would have been 20 years ago. And similarly, our average part-time worker retires with only 7 years of credited service in the plan. So you need to consider both populations in the impact of CPP integration. From my perspective, it's always good to understand how members value their retirement benefits to help trade off this. Are they willing to pay more, or should we keep the cost stable and reduce future benefits? Or should we be looking at good benefits for members to replace their standard of living and retirement income? And the next couple of slides are going to be based on data conducted as part of the Canadian Public Pension Leadership Council survey that Ipsos Reid conducted for us in 2016. The key elements are below the picture. Canadians in general want secure, predictable lifetime pension income and still desire early retirement features. This is similar across all age groups, and I have a couple slides on that. What's more interesting to me is that Canadians are actually willing to pay more if they can get those features. And as you might imagine, since you're all, I looked at the attendee list, you're all fairly good experts in pensions, these features are typically found in defined benefit pension plans. So the first key design issue that came out of the CPPLC survey is that the vast majority of Canadians, so this was a sample of 1,000 Canadians asked to give their opinion on retirement, the vast majority of these people want lifetime income. So they don't want to be running out of money. They want money that will last for the income no matter how long they live, whether that's the Canadian average of 86 or 87, or in our sectors, average age of 90 is the expected average age of death for our membership. What's most interesting to me on this slide is the far left. I had thought that younger Canadians, and I have 2 children in this far left category, weren't really considering or didn't really care about saving for retirement. We've been taught or told over many, many years that pensions are really for people. They don't start thinking of them until they get to age 45 or 55. But the dark blue bars are people who answered the question 8, 9, and 10. So they're very interested, highly desire retirement income, lifetime income, pardon me. You can see that young Canadians are in fact the most interested in this type of aspect in their pension plan. So from a plan design perspective, this is good news since it's fairly homogeneous across the different age groups on their desire for lifetime income. It makes our job a little bit easier when we go to design a solution. The second slide from the survey is that the vast majority also desire predictable income in retirement. So it's not just lifetime income, which could be purchased from an annuity, but they also want a formula base so they can plan appropriately. And you'll note that I've put in brackets that this is typically features found in a DB pension plan. So again, you can see from people who desire this, high 90%. So from my perspective, defined benefit plans are very relevant to the average Canadian today, perhaps even more relevant than they were years ago. On my opening slide, I mentioned that many people are suggesting with increased longevity that people should be working longer and retiring later. However, we asked Canadians what do they want from a pension plan perspective. And here you can see that the majority, the dark blue bars, want to retire before age 65, on average about 60%. And about 1/3 are willing to retire at age 65 or later. So early retirement features in our pension plans are still very relevant. What's interesting to me is this is what people would like to see. You know, I've seen other surveys that actually suggest that about 70% of Canadians end up retiring before they had planned on. So even though you might plan on working till age 65 or 66, sometimes reality, whether it's your health, your spouse's health, or other family situations, force you into retirement early. So having some sort of early retirement insurance or protection still relevant today as it was many years ago. And finally, in relation to the CPPL survey, 2 more slides. Even though only 2/3 or 60% plan on using early retirement features, you can see that 97% are willing to have it and pay for it as part of their pension plan. So it again reinforces the aspect that Canadians from a pension plan design perspective do want to see insurance elements. So I might not retire early, but I sure would like to have some early retirement features in my plan just in case. So even if our average age, like in CAAT, has now crept up to about 62 years on average from just below 60 a few years ago, early retirement features still remain relevant. From an actuarial perspective, as people retire a little bit older, the cost of early retirement features or having these in your pension plan is actually lower. So that's the most important part, is how much does it cost to have these features in the plan, and do members value the features that exist? So from my perspective, early retirement features are still very relevant and becoming less costly because fewer members are using them. Finally, the last slide in relation to the CPPL survey is, but are Canadians willing to pay for these features that we've just talked about? Early retirement, predictable lifetime income. And the answer from my perspective is absolutely yes. This graph, a lot of bars again, but the green bars show that Canadians are willing to contribute 10% or more of their pay toward these goals, and the blue bars 10% or less. The median was over 10%. So if we add all the 1,000 survey responses, it was about 10.5%. And if members put in 10.5% and the employers put in 10.5%, with proper governance and oversight and a robust investment policy, you can deliver a very, very healthy and valuable retirement income. So currently, the defined benefit pension plans, especially in the broader public service, are typically in that 9 to 11% of pay range, and they deliver very good benefits to the members. And this is what the rest of Canada wants as well, because this survey wasn't public sector workers, it was all Canadians, private sector, male, female, across sectors and across the country. So this is one thing that Canadians agree on, and generally, is that saving for retirement is something that's important, and they're willing to put adequate income behind it. And again, I will note on this slide on the far left, younger Canadians are the most willing to put more of their pay towards retirement goals. 67% of the people between ages 18 and 24 are willing to put 10 or more % of their pay. In fact, there are quite a few Canadians, 9% I believe, in total, who are willing to put 20% of their pay towards these retirement goals. So retirement remains relevant and across all age groups. My last couple slides, essentially, as I mentioned before, as people who design plans, trustees and sponsors, it's most important to make sure that members see and perceive value on their contributions being made. They want to make sure their plan is secure. That's mostly in regards to a funding policy or the funded ratio, because Canadians are less willing to put money if they don't think their pension plan is going to be there for them in retirement or is going to be substantially reduced. So trust and security are two key elements to convey when developing a communication plan around your plan. So the three buttons on this slide are, yes, any workplace pension I'm a big fan of. I think it helps Canadians save for retirement. Defined benefit, from my perspective, is far superior. It reduces member stress, it's more efficient, it's not volatile depending on interest rates, so people can plan and reach that goal of predictable lifetime income. And finally, I'm a big fan, as mentioned in my bio, of jointly sponsored multi-employer plans, because typically these plans don't have solvency funding, are larger, and can invest in a more robust or more diverse asset mix, which again gives more value to the members. And the employers also don't have balance sheet risk, and that's one of the main reasons why employers are getting out of the pension business, is having their pensions on their balance sheet. So a perfect design is multi-employer, jointly sponsored, to make sure that all people are at the table. From my perspective, the constant trade-off between DB and BC, between member risks, well, who owns the risk and what type of benefits you get off, I think we could start having more discussions on using multi-employer plans or jointly sponsored pension plans. So my last slide, a focus from my perspective should be on creating value to members, giving them what they want, and then managing the plan appropriately. So having a real look at what are the features that are most important to members, and also provide them the security they need. I think because not all members are the same, it's good to engage members early and often in the process to make sure that if plan design changes are being made, that they're well understood and supported and endorsed by as many members as possible. Once the design is settled, I think we also have to look at how do we create sustainability, which means cost certainty or more cost certainty for employers and getting them out of the pension risk management game, which is a key reason, again, why they're leaving defined benefit plans overall. A bigger focus right now, from my perspective, especially in the broader public sector, is trying to avoid this taxpayer backstop, which creates pension envy and, again, more pressure to convert to defined contribution plan. And finally, plan designs live a long time, sometimes 20, 30, 40 years. So always look to what the future will be, whether that's the future of your workplace or the future needs of your members or the future longevity and all the other elements that we talked about earlier on. So thank you very much. I look forward to your questions. And now I'll turn it back to Elizabeth.
Okay, thanks a lot, Derek. A lot of information there, and we move very quickly now to Phil Rivard, who is the Vice President of Pension Policy and Funding for the Local Authorities Pension Plan in Alberta Corporation, and leads the development of implementation of pension policies, funding policies, and plan rules designed to support the Local Authorities Pension Plan Board. He is a Fellow of the Canadian Institute of Actuaries and Society of Actuaries. He has served as its chairperson, the CIA Chairperson Practice Council, and is an ex officio member of the Board of Directors and Canadian Actuarial Standards Board. And I'm not going to take more of your time. I'm going to turn it directly over to Phil. Thank you, Phil.
Well, thank you, Elizabeth. Thank you for that introduction. I'm just going to, I think, add to what Derek presented so far and talk a little bit about some of the various Canadian public sector pension delivery models we have across the country. I'm going to talk about a few things. We'll look at what's, I guess, being called or defined as the Canadian pension model, looked at some of the key design or the governance features of those models and of different pension plans across the country. I do have a number of examples of different plans at the different provinces, how each one of them has different elements or characteristics. And we'll talk briefly as well about some of the challenges ahead for all pension plans in general. If we just start with the Canadian pension model, back in 2017, the World Bank published a report. It was called The Evolution of the Canadian Pension Model. Why did they pick Canada? Well, I think it's because Canada is home to, I guess, some of the world's most admired and successful public pension organizations. And so they essentially interviewed a bunch of individuals responsible and involved in different plans across the country, and they came up with this report. While it's called a model, I think it's actually better described as a set of guiding principles to follow if you want to try to succeed and in delivering delivery pensions to your participants. Some of the in that report, they classified it into 6 different principles to address in terms of key characteristics which lead or support success. The first one is to have good governance. Part of good governance is to have independence, and that is both independence in terms of operating arm's length from government, but also the ability for the entity to execute independently and to figure out what its key mission or priority is, and then to strive to achieve that in the best and most efficient means possible. It doesn't necessarily mean that there's no government involvement, because I think there always has to be a certain amount of government involvement, but that government involvement doesn't impede attaining those key principles. Important to have key leadership, both in terms of the establishment or the setting up of the organization or the entity, as well as ongoing leadership, both at the board level and the management level, I think are both key aspects. Another key governance attribute is accountability and transparency, to have robust reporting and to make sure you have codes of conduct in place to govern and to guide everybody's behavior. People and organization are also a key principle. In order to be successful, you want to have top talent and integrity. And I think the experience we've seen across the country is that There's been a recruitment for those key positions that has gone beyond the boundaries of just Canada, and it's been global to get those, to find the right individuals to lead those entities. Another, I think, key aspect of getting top talent, retaining top talent, is to offer competitive pay packages and competitive compensation to those individuals. The next key principle is investments. And I think this is an area where the Canadian plans have had somewhat of a comparative advantage with public sector plans in other countries. And one of those is the development of in-house management, the development of expertise in-house in those teams, and the realization that given the size of these plans and the amount of assets, I mean, to be successful, they really realized early on you had to have proper diversification. Not only across different asset classes, but in terms of diversification away from just Canadian exposure, so investing all over the world. And primarily, I think where Canadian plans have been more in the lead is in infrastructure, real estate, and other illiquid investments in terms of being a front runner on the private equity side and seeking out appropriate investments on that front. Last one in that category is manage risk and liabilities. And I think that's just a recognition that to do the job, the best job you can for all the participants, you cannot just look at it from an investment-only perspective. You have to consider the risks both on the liability side and the other risks to the plan, and to develop a balanced and mindful approach in investing the money. In terms of more principles, administration, what you can observe across the country is that there's been a lot of investment in both client-focused orientation, technology to support client-focused. Really, the clients are the members, and that means providing them with the right tools to support them in their retirement objectives, providing them with high-quality communication and education. And it's a whole slate, I think, of features and support that's provided to the members, because they, in the end, are the primary beneficiaries of all of these pension arrangements. The next key element is plan design and funding. And here you see, especially in the Canadian public sector, where there's sponsors with scale, certainly have, I think, more opportunity to invest in the appropriate technologies, and they have the resources to develop in-house expertise, and they have done so, and that's one of the leading features of success. These plans are operating on realistic assumptions. I think if you compare the Canadian pension plans relative to even the U.S. public sector, you'll see that the U.S. is much more optimistic, or maybe you want to say aggressive, in how they are funded, which I think puts future generations more at risk. I think the Canadian plans have done a really good job of being realistic about investment returns and the risks that are out there, and they're funding them on that basis. And that's important in terms of intergenerational equity, and that making sure that the people earning benefits today are paying their appropriate share for those benefits, and we're not going to burden future generations with these plans which are not sustainable in the long term. Risk sharing is a key element. Derek already pointed to that in terms of the ideal model, and you'll see for the most part that is part of nearly all the public sector plans that are in place across Canada, and prudent funding, important as I mentioned. The last principle I'll touch upon is just regulation and public policy. A key component of these plans and the success they've achieved is they've been able to work and operate with autonomy. And for that to occur, there has to be trust. And so it's setting up the corporations, the entities, or the structures in place such that the entities can make the appropriate decisions. They have the autonomy to implement the policies and decisions that need to be implemented. And that is, I think, a really big element in terms of the overall design. There has to be a robust regulatory regime. So whether that is having the plans subject to the same standards as the private sector, or having separates within provincial legislation, that can be done both ways. But it has to be the right regulatory regime, and those regimes have to encourage good governance. It would be nice that you could just regulate, have good governance in terms of how you administer pension plans. That wouldn't be really effective. So what you want to have is a structure that promotes good governance, and I think that's to the benefit of all the beneficiaries. Some of the key plan design features that you'll come across, I think in any pension plan you'll look at across the country, a few of them are easier to observe. So you could go on to the website for any one public sector plan, and you pretty quickly you'll be able to figure out, is it DB, is it a hybrid plan, is it target benefit, is it shared risk, is it DC, what's the benefit formula, does it have a target income replacement ratio, what is it, what's the contribution formula, is it integrated with CPP. You can look at the early retirement rules, the features, the provisions. Does it subsidize or encourage or support early retirement, or is it all actuarial equivalence? What type of indexing for inflation does it provide? Is it full? Is it partial? Is it guaranteed, or is it conditional? Or as Derek mentioned, even where it's not guaranteed, are there automatic triggers, or is it handled ad hoc basis? All of those things, I think, just with a little bit of research on the websites, you can fairly quickly figure that out on any plan. I think what's more difficult to appreciate is when you get into plans that do have conditionality of benefits. So yes, it's conditional, but what's the likelihood of receiving the full benefit? How risky? What's the probability of maybe the plan not being able to afford these conditional benefits? I think for the average member, that's much more difficult to get a sense of that type of thing, as well as who's actually bearing the risks. At the end of the day, if there's significant underperformance on the investment side, or if the economy changes such that these plans become very difficult to support, who's at risk in terms of supporting those benefits that are maybe not necessarily guaranteed, but certainly have been are expected. And those are the ones I think they're tougher to appreciate for the average member. Some of the key governance design features to look at, and there's more than just these, but who has the decision-making authority in the process? What level of autonomy do these plans operate separate from the government? Who's the legal administrator or trustee? Are the plan rules specified in the plan document? Are they in the legislation? Is administration and investment internal or external? And one of the key differences in terms of the new structures is just the board model. Some have single boards and some have bicameral boards. And really the plans with bicameral boards effectively have one board to operate the plan and to seek the best administration and investment. And they'll have a second sponsor board, which will make some of the policy decisions on benefit design and cost. There again, there's some blending and some crossover in terms of structure, but there are just quite a few different elements that varies plan to plan and structure to structure. So in going through that, I think the point I really want to make is there is no real Canadian model. There are variations across all plans and all governance designs, and really all features that I've covered exist within the public sector plans. There are no two plans are identical. There tend to be similarities from within provinces for plans within the same province. But if you're a member of a specific plan, I think there's a natural assumption that all plans operate in the same way. And I think you want to be very careful in that, because for any particular feature, I think it's much more likely to be different in other plans. And just to give you, I guess, a sample of the differences across the country, we'll go from west to east. In BC, we'll look at the public sector pension plan. It's a jointly trusteed plan with trustees appointed both by the government partner. There's a shared investment, and in terms of there's an agency, BCIMC, that invests all the money for all the public sector plans, but the plan gets to appoint one director to BCIMC, and so they have representation on how that entity is run. Similarly, there's one entity within BC to do the administration of all the public sector plans, and the plan gets to appoint two directors to that. So who primarily bears the risk in these plans? Well, this would be a jointly shared plan, and so contribution rates, whether they go up or down in the future, go equally between the employers and employees. So good or bad experience will be shared equally between both. In the BC model, in this one in particular, COLAs or indexing is conditional, and there's a separate fund set up to support COLA. And COLA is only provided to the extent it can be supported. The one unique feature here is that the board really has no ability to increase contribution rates except to comply with minimum funding standards. So if there's a desire to provide an additional level of COLA that can't be supported, that's not something the board can do independently. In Alberta, the plan I've put here is the local authorities pension plan, the plan I work for. Here, the Minister of Finance is the legal administrator and trustee, and the Minister has delegated functions to the LAP board, to APS administrator, AIMCO the investment manager. And it's interesting that the AIMCO as the investment manager has a board completely appointed by the government, and so the plan actually has no representation there. The administrator, APS, the plan does nominate one administrator, one director, so they do have some representation. But here we do have a shared risk model between the two, and there are no conditional benefits. And so in terms of a trade-off, in this chance, there's just less flexibility in terms of managing adverse investment experience or overall plan experience. There's no relief valve in terms of having conditional benefits. And so both the members and the plan sponsors are more at risk in terms of higher contribution levels. A key feature here is that the governance structure requires ongoing active involvement of the government, which can be a little bit difficult when there's other key things happening in the country. Saskatchewan, I think, is the one DC plan in terms of, in the country. And I'm not going to spend a lot of time on this. I think the key difference in terms of, because Saskatchewan is DC, is that employees bear all the risk. And it really falls upon that in terms of investment experience. And there are no guaranteed benefits. Depending on how well or poorly the plan's investments will do, will dictate how those benefits, the benefits received by individuals, ultimately retirement. I think when you consider that the standard contribution rate going into this plan is 10% total, and you compare that with probably something closer to 20% total going to DB arrangements, investments, even if they perform the same over the long term, and I think there's good arguments DB is much more efficient, it's not difficult to see that the levels of retirement income coming out of this arrangement are going to be lower than your typical DB plan. Manitoba plan, a little bit different again, jointly trusteed investment management. It's a combination of internal and external. The difference with Manitoba in terms of their structure, the key one, is that historically there was no employer contribution rate. And what they did at the outset was the employees contributed and the employer simply paid half of the benefits at the end of the day. Now that has changed over time, and there's a movement towards funding the employer obligation. But certainly at this point, there's a huge funding deficiency or an unfunded piece. And the other interesting fact is there's actually no current minimum funding standard. This plan is not subject to any minimum funding standard. Moving to Ontario has quite a number of significant public sector boards or plans. It just chose OMERS as the model. They have the bicameral board I mentioned earlier, so there's both a sponsor and a trustee corporation, internal investments, internal administration. And one of the challenges OMERS will highlight, if you look at their website, is funding risk and plan maturity. And so those are some of those challenges that are really they are looking at. And I believe as considering those challenges, the sponsor board is currently looking at a conditional indexing approach. And that's something that is being considered. I know it's been considered in the past, but to date, it has not been adopted by those sponsors.
Phil, I'm sorry to interrupt. Phil, I'm sorry to interrupt. It's Elizabeth. We're running very close to the 45-minute mark. I've just asked with Cher, we can extend by a few minutes. Hopefully, that's all right with the audience. Because I think it is helpful for us to have this information, and we have one question. So I hope that works for you. Thank you.
Yeah, actually, I'm just going to, sorry, I've run a little long. I'm just going to wrap up with New Brunswick. I think this is the last really unique arrangement, because they're the model that's, I think when you read the articles that have come out, they're called the share risk plans. Now, excluding the Saskatchewan model, I think all those previous examples truly are shared risk. This one does share risk, but it actually, I think, puts a little bit more risk on employees than the employers. And the difference here is that while the plan, both contribution rates can go equally for employees and employers, at a certain point, there's certain tests in place that if these funding standards are not met, well, then benefits start being reduced. So there's conditional indexing and as well as conditional benefits. And the other unique feature here is that there's legislated triggers and measures that in place that act like triggers, and they're determined using some pretty sophisticated open group stochastic modeling, which we don't see anywhere else in the country. So I'm going to leave it at that. I think there's a couple of other provinces I was going to cover, but the key message here is that each model is a little bit different, is a little bit unique, and they're kind of customized to adopt the situation and then the needs of each province or pension plan.
All right, thank you very much both, and thank you to the audience for your patience. It seems there's never a shortage of stuff to talk about, or there's always a shortage of time. We have one question, and before we get to that, just remind the audience who may need to leave, our next webinar is on March 7th on trustee perspectives on facing the infrastructure challenge on pension boards, and then on April 18th, we're going to talk about investing for impact. And we will have these webinars available online for review. So if you've had to leave us, thank you very much for joining us. If our panelists can stay, and we have one question here from the audience, which is, can you give us an example of a successful plan member engagement on plan design? And I don't know who asked the question, but maybe we'll go to Derek first.
Sure, I'm happy to take that. So several years ago, clearly actuaries were recognizing that longevity was improving, and given that that would result in higher liabilities, there was a need to increase our basic contribution rates at the CAAT pension plan. So we made sure that we had our fundamental principles in place, the most important one being benefit security, and all of our members and our employers buy into that process and that principle, as well as contribution stability, etc. But the mortality tables came right after the global financial crisis. So we were already dealing with having to manage through an asset loss at that time. So the engagement that we had with our members was really making sure that they understood that the reason that the contribution rates were going up weren't because of the global financial crisis. We were able to weather that storm through actuarial smoothing and quite a nice bounce in the markets overall. But at the same time, that longevity is going up. So rather than just saying, hey, longevity is going up, can you pay an extra 1% of pay towards this to your pension plan? We didn't think our 25,000 active members would like that. So our communication program with our actives was very robust and telling them about the trend on increasing in longevity, but that it was resulting for our average member in 36 to 45 extra pension payments that they will receive. So based on that, they understood, okay, I'm paying more, but I'm essentially getting more from the pension plan as well, and that seemed like a fair trade-off. As I mentioned, we had 25,000 active members at that time. When you're increasing contribution rates, and the actual rate was 1.6% for our average member, we were expecting about 10% of our members to call in and be very unhappy with the increase in contribution rates, especially because they coupled previous increases, previous years, not too far in the past from when that was happening. So we were expecting 2,500 members to call, but because of the examples we used, the illustration, the engagement we had with members, we had empowered our local union leaders with information, not only those who served on our board, but also across all of our employers. And I expect they got a few questions, but in fact, there was 0 negative calls that the plan received, even though contribution rates were going up by 1.6%. So it's not a traditional benefit plan change design, but in this day and age, we also have to manage how we're communicating contribution rate increases So from my perspective, that was a very successful engagement of members, making sure they understood what they were getting for their contribution rates.
Okay, thank you. And Phil, have you got an example that you can share with the group?
I don't know that I would refer to any one example, but from my perspective, a successful engagement is one that results in a pension plan that's sustainable in the long term. I don't think it's in anybody's benefit to have an arrangement which is not sustainable. And so when you look at some of the changes recently, whether it's in New Brunswick or Newfoundland, I think at the end of the day, the outcome might not have been the preferred solution for all participants, but if it's supportable and sustainable, I think it does best address everybody's needs. Because the worst outcome is to really have an expectation or reliance on these arrangements that are just not deliverable in the long term. So I think engaging all the stakeholders to come out with supportable and sustainable solutions is, I think, a model that has to be pursued.
All right, thank you very much. And those are the questions we have. And as we are going over time, I think we'll just thank our presenters, Phil Rivard and Derek Dobson, for taking the time and providing us with your perspective for this. We certainly hope that our audience is finding these webinars useful in your pension practice or interest. And I want to also thank Shareholder Association for Research and Education for helping us in organizing these, and today particularly Hugues Letourneau, who is running the technology for us behind the scenes. Thank you very much, Hugues. With that, thank you all, and we hope to be with you on March 7th. So long.